I want to start with a number that should be on the front page of every financial newspaper on the planet right now. The number is $1.2 trillion. That is how much United States government debt Japan currently holds. Not China, not Saudi Arabia, Japan. The single largest foreign creditor of the American government, sitting on $1.2 trillion in US Treasury bonds, has just watched its domestic bond market produce returns that make American paper look unattractive for the first time in 30 years. The Japanese 10-year government bond yield is currently at 2.45%, a 28-year high. The Japanese 40-year bond yield hit a record 4.2% in January 2026, a move so violent that $170 million in selling destroyed $41 billion in market value in a single session. Bloomberg's macro team called it the financial San Andreas fault line, and every tremor, they wrote, brings the big one closer. What I want you to understand today is not what is happening in Japan. What I want you to understand is what happens to your treasury bonds, your mortgage rate, and your dollar position begins moving, not if, when. Because the arithmetic that drove Japanese investors into American paper for 3 decades has already reversed. The incentive is gone. The question is not whether the capital comes home. The question is how fast. And the difference between a slow repatriation and a fast one is the difference between a manageable rise in US Treasury yields and the kind of global bond market dislocation that forces the Federal Reserve into a response that makes everything I have described in the worst trap and the petrodollar collapse look like a warm-up act. I have been watching how leverage cycles unwind across global capital markets for over 40 years, and what I am going to show you today is not speculation. It is a mechanical sequence already in motion with a historical precedent that is more precise and more frightening than almost anything being discussed in mainstream financial media right now. Subscribe now. Here is the mechanism. Write this down, because until you understand this sequence precisely, the headlines coming out of Tokyo over the next 6 months will look like noise rather than the signal they actually are. Step 1. For 30 years, from roughly 1995 to 2025, the Bank of Japan maintained interest rates at or near zero, sometimes negative. The logic was straightforward. Japan had been trapped in deflation since the asset bubble collapse of 1990. Low rates were supposed to stimulate growth, fight deflation, and keep the cost of servicing Japan's government debt, which now stands at 260% of GDP, the highest debt-to-GDP ratio of any developed nation on earth, manageable. The side effect of 30 years of near-zero Japanese rates was a trade that became one of the largest structural sources of demand for American assets in the entire global financial system. The yen carry trade. Step 2. The yen carry trade is a mechanism so simple and so powerful that at its peak it was estimated to involve at least $4 trillion in positions globally. Here is how it works. You borrow yen at near-zero interest rates. You convert those yen into dollars. You use those dollars to buy higher-yielding assets, American Treasury bonds paying 4 to 5%, American equities delivering 10% annual returns, American real estate, American corporate bonds. You earn the spread between what you pay in Japan near zero and what you earn in America, 4 to 5%. You pocket the difference. You repeat at scale. Japanese pension funds, insurance companies, regional banks, and individual retail investors, known as Mrs. Watanabe, have been running versions of this trade for 3 decades. The accumulated position is not $500 billion. According to the most comprehensive estimates available, including TD Economics research published in March 2026, Japanese investors hold $5 trillion in foreign assets globally, with roughly $1.2 trillion of that in US Treasuries alone, representing approximately 4% of the entire outstanding US government debt market. Step 3. In March 2024, the Bank of Japan did something it had not done since 1995. It exited its yield curve control framework and began hiking rates. By December 2025, the BOJ policy rate stood at 0.75%, its highest level in 30 years. The 10-year Japanese government bond yield rose to 2.45% as of April 2026, its highest level since 1999. And here is the specific number that breaks the carry trade's arithmetic. A Japanese institutional investor who buys a 10-year US Treasury today and fully hedges the currency risk back to yen earns approximately negative 1.57%, not a positive return, a negative return, after currency hedging costs, which have risen sharply as the interest rate differential between the US and Japan has narrowed. Holding American government debt is loss-generating for the Japanese investor who wants to eliminate currency risk. For the first time in 30 years, Japanese investors can earn more on a risk-adjusted currency hedged basis by buying Japanese bonds than by buying American ones. The incentive that drove $1.2 trillion into US Treasuries has reversed. Step 4. Ministry of Finance data from Japan shows sustained net sales of foreign securities totaling approximately 4 trillion yen, equivalent to roughly $25 billion since the start of 2026. This is the carry trade unwinding, not at crisis speed, not yet. But the direction is set and the arithmetic is forcing it. Japanese insurance companies and pension funds, which hold long-duration liability-matched portfolios, are beginning to redirect new capital into domestic bonds rather than foreign ones. They are not panic selling. They are not making a dramatic announcement. They are simply doing the math and allocating to where the math sends them, and the math sends them home. Step 5. Here is where your treasury bonds, your mortgage rate, and your retirement account enter the equation. Japan is the largest foreign holder of U.S. government debt. When the largest foreign creditor of the American government stops buying and begins selling, the demand side of the treasury market weakens at exactly the moment when the supply side is exploding. The United States must refinance $9.2 trillion in maturing debt this fiscal year. It must finance an annual budget deficit running at approximately $2 trillion. That is $11 trillion in Treasury issuance that needs buyers in 2026 alone. Remove Japan from the buyer pool. Reduce China's participation. The market must clear at a price, and the price of absorbing more supply with less demand is higher yields. Higher yields mean higher mortgage rates, higher corporate borrowing costs, higher interest payments on every form of dollar-denominated debt. And the Federal Reserve, already trapped between 3.1% inflation and 0.7% GDP growth, faces a bond market adding pressure from Tokyo rather than relief. The San Andreas Fault is moving. Now I want to show you the historical record because this is not the first time a massive carry trade has unwound, and the consequences are documented precisely. In August 2024, the Bank of Japan raised rates by 15 basis points, a move so small it should have been manageable. The reaction was not manageable. The Nasdaq fell 13% in less than 3 weeks. The VIX, the volatility index, spiked to 65, a level last seen during the peak of the 2020 COVID crisis. The S&P 500 fell 8% in 3 days. Japanese stocks fell 12% in a single session, their worst day since 1987. And the critical insight from that event is this: that was estimated to represent approximately 10% of the carry trade positions being unwound. A 10% unwind of the trade produced a VIX of 65 and a 13% Nasdaq correction in 3 weeks. The full-size trade, at the TD Economics estimate of $4 trillion in total carry positions, has not unwound. It has barely started. BOJ rates are projected to reach 1% by year-end 2026. At 1%, Japanese rates against current U.S. rates of 3.5 to 3.75%, the carry trade still exists, but it is shrinking. And the direction of travel, every rate hike the BOJ delivers, every basis point of JGB yield increase, every trillion yen of foreign securities sold by Japanese pension funds is toward the exit. The question for every investor is not whether this unwind happens. The August 2024 episode already proved what a partial unwind looks like. The question is the speed. And the speed is determined by 2 variables that are both moving in the wrong direction simultaneously. The Bank of Japan is tightening, and the United States, with $2 trillion annual deficits and $9.2 trillion in refinancing needs, is adding treasury supply at a pace that requires every available buyer to show up at every auction. Remove Japan from the buyer pool as the BOJ normalizes rates. Watch what happens to U.S. yields at the long end of the curve. It is already happening. The US 30-year Treasury yield approached 4.9% in January 2026, levels not seen since before the 2008 financial crisis. That was the tremor, the San Andreas fault moved, but the big one has not arrived. Let me be specific about the two scenarios that determine how this plays out, because understanding the difference between them is the most important thing you can do with this information right now. Scenario 1. The carry trade unwinds slowly. The BOJ raises rates gradually in 25 basis point increments toward 1% by year-end 2026. Japanese pension funds and insurance companies redirect new capital into domestic bonds rather than foreign ones, but they do not sell their existing US Treasury holdings. The reduction in Japanese Treasury demand is gradual. US Treasury yields at the 10-year level rise to 4.5 to 5% over the course of 2026, driven by the combination of reduced Japanese demand, continued US deficit spending, and the $9.2 trillion refinancing wave. The Federal Reserve is forced to choose between letting yields rise, which tightens financial conditions and deepens the economic slowdown, or buying treasuries itself through the Reserve Management Purchase Program it began quietly in December 2025 at $40 billion per month. If the Fed expands that program to absorb the reduction in Japanese demand, it is effectively monetizing the debt that Japan is no longer financing. That monetization, when it reaches scale, is gold's most powerful structural catalyst. In the slow unwind scenario, the upward pressure on U.S. yields is persistent and grinding. Every mortgage refinanced in 2026 is more expensive. Every corporate bond issued costs more. The economy, already running at 0.7% GDP growth, faces a sustained tightening from the bond market even if the Fed holds rates steady. And gold, which moves inversely to the real yield on the 10-year Treasury, faces less mechanical suppression as the yield curve steepens, and the Fed's ability to credibly fight inflation without destroying the fiscal position of the government becomes more obviously constrained. Scenario 2. The carry trade unwinds fast, a trigger event, the most likely candidates being a sharp yen strengthening beyond 140 per dollar, a geopolitical shock that drives risk aversion globally, or a credit event in the U.S. private sector that triggers margin calls across leveraged positions simultaneously, forces rapid liquidation of yen-funded assets. Japanese hedge funds and global investors who have borrowed in yen and deployed into U.S. equities, U.S. Treasuries, and emerging market assets must sell to buy back yen and repay their loans. In August 2024, the trigger was a 15 basis point BOJ rate hike. The yen moved from 161 to 142 per dollar in less than 3 weeks. The Nasdaq fell 13%. The VIX hit 65. Now run that scenario with a larger position size, a more fragile global financial environment, oil above $100, the Strait of Hormuz partially closed, the Federal Reserve unable to cut rates because core PCE is running at 3.1%, and a private credit sector with $440 billion in zombie funds using accounting vehicles to mask losses that will eventually materialize. The fast unwind scenario does not look like August 2024. It looks like 2008 in terms of liquidity stress, with the critical difference that in 2008, the Federal Reserve could cut rates to zero and expand its balance sheet from $900 billion to $4 trillion without inflation constraints. In 2026, the Federal Reserve is cutting into 3.1% inflation with $39 trillion in debt. It cannot deploy the same response, which means the carry trade unwind in its fast scenario produces a liquidity crisis that the Fed cannot fully offset, that the Treasury cannot easily absorb, and that ultimately forces the kind of fiscal and monetary response, yield curve control, open-ended quantitative easing under a new name that is gold's most extreme structural catalyst. In both scenarios, the direction for gold is the same. Persistent upward pressure on U.S. yields creates the conditions for Fed monetization. Fast unwind creates the conditions for emergency monetization. The question is only the timeline and the magnitude of the move. Now, I want to address the counter-argument directly because it is being made by serious people and it deserves a serious answer. The counter-argument is this: Japan has been running this carry trade for 3 decades and it has never triggered the crisis that analysts periodically predict. In August 2024, the BOJ hiked 15 basis points and the unwind was severe but short-lived. Within weeks, the BOJ walked back its hawkish language. Markets recovered, the Nasdaq recovered, the yen weakened again, carry trade positions rebuilt. Therefore, the prediction of a disorderly carry trade unwind has been wrong every time it has been made, and there is no reason to believe 2026 is different. This argument is worth taking seriously, and here is the precise reason it does not apply to the configuration that exists in April 2026. In August 2024, the Bank of Japan had the option to pause. Global inflation was falling. The Fed was beginning to signal rate cuts. The macroeconomic environment gave the BOJ room to back away from the rate hike path and allow carry trade positions to rebuild. That option does not exist in April 2026. Japan's domestic inflation is running at 3%, above the BOJ's 2% target for 4 consecutive years. The Iran war has driven oil above $100 per barrel. Japan imports approximately 90% of its energy. Every dollar of oil price increase translates directly into higher Japanese import costs, higher domestic inflation, and more pressure on the BOJ to continue normalizing rates rather than pausing. The BOJ cannot pause in the same way it could in late 2024. The inflation reality in Japan, driven by a global oil shock that the BOJ cannot control, is forcing continued rate normalization regardless of what it does to the carry trade. And simultaneously, on the American side of the equation, the Federal Reserve cannot cut rates to reduce the attractiveness of dollar assets because core PCE is running at 3.1% with month-over-month prints of 0.4%. The spread between Japanese and American rates is narrowing from both ends simultaneously. The BOJ is raising. The Fed cannot cut. That combination, tightening from Japan and trapped American rates, is the configuration that the August 2024 episode did not have, which is why August 2024 recovered, and why 2026 is structurally different. Now, let me give you the 3 signals I am personally watching to determine which scenario is developing, because knowing which path the carry trade takes changes everything about the timing of what comes next. The first signal is USD-JPY, the dollar to yen exchange rate, currently hovering around 150 per dollar. The critical threshold levels are precise and documented. At 145, the first layer of carry trade stop losses begins triggering. Estimated $500 billion in positions begin closing. At 140, institutional risk limits are breached and forced selling accelerates. At 135, the panic zone. Margin calls cascade. G7 emergency coordination becomes necessary. Watch USD-JPY every day. It is the single most important number in global finance right now for understanding the timing of what is coming. When it breaks below 145, the carry trade is in active distress. The second signal is the Japanese Ministry of Finance weekly foreign securities data. This is the data point that tells you whether Japanese institutional investors are reducing foreign bond holdings or merely redirecting new money. When the weekly data shows net selling of foreign bonds exceeding 1 trillion yen per week for 3 consecutive weeks, the structural repatriation has begun at scale. Not portfolio adjustment, structural repatriation. The third signal is the US Treasury 30-year yield. The 30-year Treasury at 4.9% as of January 2026 is the instrument most sensitive to the reduction in Japanese demand because Japanese pension funds and insurance companies have historically been the largest buyers of long-duration American government debt. When the 30-year yield rises above 5% and stays there for more than 2 weeks, the bond market is pricing the permanent reduction in Japanese demand, not a temporary spike, a permanent repricing of the term premium on U.S. government debt. Write down those 3 signals. USD-JPY below 145. Weekly Japanese foreign bonds selling above 1 trillion yen for 3 consecutive weeks. U.S. 30-year yield above 5% sustained. When all 3 appear simultaneously, the carry trade is in active unwind at scale. Everything that follows from that moment in the bond market, in the equity market, and in the gold market will be larger and faster than August 2024. I want to close with the insight that I think most investors are missing about what Japan's bond market means for gold specifically, because the connection is not obvious and it is the most important one to understand. Most investors think about gold as an inflation hedge or a safe haven. Those are the proximate drivers. The structural driver, the one that takes gold from its current level to the institutional targets of $5,400 to $6,300 that Goldman Sachs, JP Morgan, and Deutsche Bank have published and maintained through the most volatile correction in 3 years, is the fiscal arithmetic of the American government. And Japan is the variable that makes that arithmetic more extreme, more urgent, and more undeniable with every basis point the Bank of Japan raises. Here is the connection. When Japan reduces its treasury holdings, the US government must find alternative buyers for its debt. The alternatives are domestic buyers, who are already absorbing more than ever before, foreign central banks excluding Japan, whose participation is already declining as de-dollarization accelerates, or the Federal Reserve itself. When the Federal Reserve buys treasuries, it creates new dollars. New dollars reduce the purchasing power of existing dollars. Reduced purchasing power of the dollar is the precise condition under which gold performs most powerfully. The Japan carry trade unwind is not a separate story from the petrodollar collapse, from the wash trap, from the central bank gold buying at record levels. It is the same story told from a different angle. It is the leverage cycle responding to the same underlying reality that the debt cycle has already produced. The dollar is the most borrowed currency in human history. The structures built on that borrowing, the petrodollar system, the yen carry trade, the $7.6 trillion in foreign-held US Treasuries are unwinding together, not simultaneously, not in a straight line, but in the same direction. And gold, which has no counterparty, which cannot be sanctioned or frozen or printed, which 95% of central banks expect to increase as a share of their reserves over the next 12 months, is the asset that prices the unwinding of those structures before the mainstream financial press recognizes them as structural rather than episodic. There are two types of investors watching Japan's bond market right now. The first type sees a distant country's interest rate problem and concludes it has nothing to do with their American retirement account. They do not track USD JPY. They do not read the Japanese Ministry of Finance weekly foreign securities data. They do not watch the US 30-year Treasury yield for signs of sustained repricing. They will discover the connection between Tokyo and their portfolio at exactly the wrong moment, when the carry trade is already unwinding at speed and the liquidity that seemed permanent has already left the building. The second type understands that in the modern global financial system, the largest leveraged trade in the world cannot unwind without consequences that reach every asset class, every yield curve, every currency pair, and every gold price on every exchange simultaneously. They watch USD JPY. They track the Ministry of Finance data. They watch the 30-year yield. And they understand that the San Andreas fault line that Bloomberg identified in Tokyo is not a Japan problem. It is a global leverage problem. And the tremors that have already happened, January 2026's 40-year JGB explosion, the $41 billion destroyed by $170 million in selling, the US 30-year yield approaching 4.9% are not the event. They are the warning. Watch USD JPY. Watch the Ministry of Finance data, watch the 30-year yield, and understand that the $1.2 trillion question is not whether Japan's money comes home, it is whether it walks or runs. Most investors will not know the difference until it is already too late. Now you do.